Hey everybody, welcome back to Firm and Final. I'm Mabe Koja, I'm your host, and today we're talking about how large consulting firms play a role in stop loss and reinsurance. And joining me today, I have Andrew Peel, who is the national stop loss leader at Mercer. We have Laurie Horan, who is a senior financial analyst at Marsh McLennan agency. And we have Carol Adams, who's a senior vice president and actuary at Guy Carpenter. And you guys all have one thing in common. You all work for Marsh McLennan companies. And so as we get started, I thought it would be great if you guys just gave a brief intro about yourselves and what role you play in the stop loss and reinsurance industries. Laurie, why don't we start with you?
Sure. So my name's Laurie Horan LeBlanc, actually, and I have been working at Marsh for the last 6 years. I started off my career in underwriting at an MGU, went to a carrier, and then made my way over to the broker side. So I have really enjoyed learning more about stop loss, from the different perspective of being closer to the client, as well as just being able to use my underwriting knowledge in that capacity.
Awesome. Carol, how about you?
Yeah, thank you, Mabe, for having me. Carol Adams. I work in the life accident and health practice of Guy Carpenter. I have over 30 plus years of experience in the life accident and health side. I lead our employer stop loss vertical within our life accident and health practice. We work with employers, captives, health plans, insurers, and reinsurers. And it's a pleasure to be here in our conversation.
Awesome. And Andrew, why don't you bring us home?
Yeah, appreciate you having me, Mabe. Andrew Peel, as Mabe mentioned, I'm Mercer's national stop loss leader. Been with Mercer for 18 years, been in this role for 4. Mercer has a stop loss center of excellence that handles all stop loss placements for our clients throughout the country. So before I was the national stop loss leader, I was our East region lead. And pretty much since I started with Mercer, I've been heavily involved in stop loss. So whether it's, traditional stop loss, captives, within Mercer and the MMC family of companies, we're certainly here to help with clients and all different needs.
Yeah, awesome. And just full disclosure, I worked previously at Mercer for 14 years, so I'm very familiar from the stuff that Andrew just explained. I worked on that team as well, and very familiar with all the other Marsh McLennan companies. And right now, it feels like it's really been a tale of two markets at the moment. When we talk to the big stop loss consulting firms and when we talk to stop loss carriers, it feels to me like stop loss carriers are struggling. It's, they want to feel like it's a hardening market, but the brokers are telling a different story. And while there seems to be some loss ratio challenges out there, it still seems like there's a lot of stop loss capacity. So what gives? And really, I would start with Andrew and Laurie from a stop loss broker's perspective. What's the deal with the market right now?
Yeah, I think it's kind of a mixed bag right now. I do think that the market is a little bit harder than it's been, from the sense that for groups that are running closer to target or maybe not running well, it's a little bit harder for us to find a good home for them, harder to find a stop loss carrier who's willing to take a flyer on them and provide kind of better pricing than maybe their incumbent. But the flip side is also true for the groups that are running well. It's a very aggressive market. Seems like the stop loss carriers are all fighting over the good cases. It's a bit of a race to the bottom there. So it's not uncommon for groups that are running well to go out to bid to end up getting renewals that are close to current or even below current, again, because everyone wants those good cases. It's just the cases that are not running as well. It's a bit harder to find a home. And if I look at the past couple of years, we've seen average renewal increases tick up a few points, I think largely driven by the increased frequency and severity of high-cost claimants that have hit our carriers' books. But I don't think it's been anything widespread, and I also don't think it's consistent from carrier to carrier. We've seen a few carriers over the past year or so have some real loss ratio struggles, but that's not also true of everybody, right? Stop loss is a bit cyclical. You would expect as a stop loss carrier, every several years, you're going to have one of those years where it's a real struggle, but
Sure.
We haven't seen that across the board for all carriers. So it's an interesting dynamic right now of both, an aggressive market and some challenges for the other groups.
Yeah, Laurie, are you seeing similar or something different?
I would echo that statement. Pretty much Exactly. But I would also add that, I think that really then emphasizes our role in the market as far as trying to work with carriers, build relationships, make sure that we're getting the best deal we can for the clients overall. It also puts a lot of pressure on us to try to get better data to provide to the carriers so that they can fine-tune that process. But I would agree. I think there'll be more convergence. There'll be the extremes, but there'll be more convergence around leverage trend this year. We're just trying to plan and make sure that we're all tracking to the same model.
Sure. Carol, what's your sense from like a reinsurance perspective? Is it a hardening market or is it a market full of capacity?
Yeah, so I would echo what Andrew and Laurie said. I mean, some carriers, insurance carriers, are struggling for profitability, but some have already worked through those challenges. So some have kept ahead of the trends and already built that in. Some are going through that pain. So it really depends what cycle you're in from the insurance perspective there.
Yeah.
Now, looking on the reinsurance side, we are starting to see a broader range of renewal increases. So giving more credit to those portfolios that are running well, and then also adjusting on the higher side. So for those blocks of businesses that have some more challenges on the loss ratio.
Yeah, very interesting. And you guys all said this, it's like a cyclical market out there. And, carriers and reinsurers at different times will struggle. We're seeing that there's some new capacity coming into both the stop loss and reinsurance space. What makes this industry attractive for these new entrants?
I mean, I would say the profit margins, right? If you look at what a stop loss carrier typically targets from a loss ratio perspective, it's somewhere in the 70 to 75% range. And I think we all know not all of that is profit margin, but a good chunk of it is. So if you're able to write the correct business, if you're able to write profitable business, there's some large margins associated with that. So for a company who's looking to get into stop loss, that's appealing, right? Is that large profit margin. It's easier said than done, though, right? Getting into the market and trying to build a book from the ground up is very challenging. There's, a lot of carriers already out there. It's very difficult to earn market share. So, you almost have to look at, buying a block to kind of get yourself going versus building it up organically. But from the outside looking in, for a carrier who's looking for the first time, those profit margins are certainly appealing.
And I'd add to that saying that it's a $40 billion marketplace, right? So that's going to catch companies' attentions. And
I was going to say the same thing, growth market.
Whether it's like new capacity or whether it's private equity that's coming into the market space, venture capital, existing players looking to expand their product offerings. It's a big number, year over year. Compounded growth of double digits. So a lot of favorable things in the marketplace. Plus, if you think about it, employer stop loss, there's not, you have your filings, of course, on the carrier side, but there's not a lot of hurdles or barriers to entry. You can get into the market. Now, growing and keeping it profitable is the other challenge of it, but getting into the market's pretty attractive.
I would also say that, I feel like the number of clients that are considering moving from fully insured to self-funded continues to grow every year, which is further expanding the market. So, you talk about a $40 billion industry that's ever growing, as more and more groups kind of move into that market and need stop loss.
Yeah, and I was going to add too, like the technology with AI and being able to more easily evaluate. I think that also can make for a niche market for people to either enter or try to put their foot in that place and go forward as far as, entering the market.
All right, so I want to challenge something that Andrew said about the stop loss carriers being in a market that has a lot of margins in it. When I think back to the NAIC reports from 10, 12 years ago, it used to be that stop loss ratios ran in the 60s, maybe low 70s. And I feel at that level, there is a lot of margin in the product. But based on the recent NAIC results, the market's running in the low 80s. And when you think of premium tax being 2.5%, when you think of broker commissions and overrides being anywhere between 5 to 10%, and then just your typical costs of operating your own business, let alone driving an underwriting margin, I don't think the margins are as high as they used to be. So I guess I'll ask the question again. Why is it that new entrants are coming into this market if the margins are just not what they used to be in the past?
Yeah, I think that's fair. As far as what the target loss ratio is, right? In theory, the margins would be there for it to be really attractive. But I would lean more towards kind of what Laurie was saying before, is it's a very large industry. It's a $40 billion industry that's ever growing. So I'm sure carriers who are coming into the market for the first time feel they can do a better job, right? They wouldn't be doing so and getting into it unless they felt like they could be profitable. So I just think the opportunity is there to grow based off of the size of the market.
So we do have a lot of new carriers and reinsurers coming into this space. I guess from like your seat as the advisor to employers or the advisor to a health plan or a stop loss carrier who's looking for reinsurance, how do you get them comfortable with new capacity, with a new stop loss carrier, a new reinsurer in the space?
Yeah, from my end, it takes a lot. We have a number of carrier partners that we work with, that we have agreements with. It's based off of a long history. It's based off of premium volume, their place in the market. So for a new entrant, they really have to prove themselves for a while before we're really comfortable recommending them. And, it's less on the terms and conditions standpoint because, we do our due diligence to make sure that the contracts are secure, et cetera. But for a new entrant who doesn't have a lot of premium volume and history related to claims payment, we have to be comfortable telling clients that, if there is a claim, it is going to be paid. This carrier is going to be around for the long haul, et cetera. So, we go through a pretty thorough process on our end with new entrants to maybe give them some opportunities, but it really takes a while to build up that trust before we're able to, strongly recommend that, hey, this is a good carrier. We think this is a good fit.
Yeah, and I was just going to add as well that, I think that without that test, I think that the market can sometimes question whether or not the deal is too good to be true. So we try to, monitor that as well when we're seeing that maybe somebody's just being a little too aggressive. That's a little bit of a red flag. We want to see competitive rates, but we also want to make sure that clients aren't facing extremely high increases in subsequent years or, not having products that they've had in the past. So just doing our due diligence is even more important.
Yeah, Laurie, I think that's a common concern is a carrier buying the business, right? Mm-hmm. If it's a new entrant and the rate's really low, there may be some hesitancy there. Is the carrier buying the business? Now, obviously, there's ways to become more secure that they're not buying the business by having appropriate renewal protections in place, right? But it's still a valid concern, and it's difficult as an advisor to say that they aren't trying to win the business or buy the business if we don't have that history and experience with them and saying this is not their normal practice. They're a good reputable carrier. If they don't have that history, there can definitely be more caution before we go ahead and recommend them.
And it's one thing to test the quoting market to be comfortable with that, but until you actually get to a point where you have claims with that particular carrier, that's where you really test how they're going to operate and how you're going to be able to, work with them in order to make sure that claims are paid expediently and appropriately.
Everything's easy until you have a $5 million claim. Right? Carol, from your seat as like an advisor to insurance companies, how do you get comfortable advising that they go with a new capacity provider?
Yeah, our process is very similar to what Andrew and Laurie are saying. It is a very rigorous process that we go through to have an approved market on our list to offer to our clients. So it's not only financial and capabilities, it's also commitment to the marketplace, it's also reputation. So, we put new entrants under a lot of scrutiny. We even put the markets that are on our lists under a lot of scrutiny, right? It's a constant effort to make sure, we are comfortable with who we are recommending to our clients. Now, to our discussion earlier, there are some new players who had seats at old players. So you are seeing people, and it's very much a people and relationship
Very much.
business. So you are seeing people crop up in new markets and, representing new papers, but there are people who have been longstanding in the business and also are well regarded and have that reputation too. So those things sometimes make it easier to get comfortable with recommending a new market to our client
Okay, so
base.
that's a great point. I want to press on that for a second. What's more important? Do you trust the credibility of the people on the team or the credibility of the insurance paper or the reinsurer and their level of surplus and their AM Best rating? What's more important?
It has to go hand in hand. I mean, you can't pick one. Obviously, financially, you have to have a strong entity. If you have great people without that bag of money supporting it, that's not going to work. But at the end of the day, there is an element of relationship that's very critical to doing business. We've all been in this industry for a long time. Reputation is everything. And, people who have done well, who are committed, who have a longer term view, and have been in the market for a while to see different things, different cycles, not react, overreact, underreact, certainly play a valuable role in the market.
Reputation is everything, and you guys have all mentioned that you really get tested when it comes downtime to paying a claim. Tell me, what's like the worst claim situation you've ever seen?
I'll just give one recently, and it's something that we're starting to see more, is with providers waiting until the end of the filing period to actually file claims for possibly long hospital stays. So you could have incurred dates on a claim that go back a couple of years, both because of the long hospital stay and the provider waiting until the end of the filing period, which can certainly lead to issues from a claim payment processing standpoint. And it's very difficult to push back on the administrators as far as their process is concerned, right? I think when you look at a typical process, like from our end on a really long hospital stay, there's a lot of holes that you can poke at what actually transpired and the lengthy delays between filing up for additional records, et cetera, or additional questions that come up. But we've recently seen, a few instances where those long tails and those delays have led to claims falling outside of the policy period. It's a big reason why I think we've seen the industry that historically was comfortable with, a 24/12 contract basis on new business. It's very hard now to recommend a client move to a new carrier on a 24/12 basis because we don't know what we don't know. And we don't want to advise a client to make that move and then end up with a claim denial as a result of it. So I think it's a big reason why, 3612 has started to become the more industry standard from a contract basis standpoint to try and eliminate that gap as much as possible.
Interesting.
I would just say in general, the worst claims we end up seeing are the surprise ones, right? If you think about it from a reinsurance perspective, the ones the carrier doesn't know about, the ones they find out late, and then subsequently the reinsurer finds out late. Now you're heading into a renewal with some big surprises that no one was expecting along the way. And we have to figure out how to deal with that.
Yeah, I think there are some real gaps in kind of the advanced notification process on the administrator side. Somebody knows that claim exists somewhere, right? And it makes it very difficult for like a disclosure, right? So if you're moving a client to a new carrier and then all of a sudden one of these claims hits and then there's a lot of questions, once you look at the dates of stay for the hospital, how did nobody know about this? We would have done things differently from an underwriting standpoint if we had known about this claimant. There's a lot of finger pointing there. And I just think some do a better job than others, but no one does a really great job at providing that advanced notification that something is out there that hasn't yet hit a claim report.
Sure.
Yeah, and I was just going to mention too that, the hospitals are often holding bills, but, interim bills from hospitals can be an issue as well. If a claimant is in the hospital and we're not getting any sort of paid claim information about it, we're then in a position of trying to deal with it when it finally pops. And that is devastating to the client. It's a surprise to everybody. And, then trying to figure out what the best solution is to
Sure.
fix the problem.
Let's shift the topic a little bit. And I think one of the hot topics in stop loss and reinsurance right now is captives. And it could be small group captives, and that's, a product that a bunch of smaller groups are banding together. Or it could be a single parent captive that larger employers are using. Are you guys coming across captives in the work that you guys do?
Every single day.
Tell me more.
Yeah. So for us, it's more so on the single parent captives than the smaller stuff. On the smaller stuff, it does come across my desk every so often. It's typically your fully insured clients that are looking to go self-funded for the first time, but aren't necessarily comfortable with the risk associated with that and the volatility. So that can be kind of a foot in the door to self-funding.
Sure.
But that is less frequent. I have a lot of conversations on a daily basis related to single parent captives. Typically, from my end, makes the most sense when it's a larger jumbo employer who already has a captive that is set up for other lines of coverage, and they are looking to expand the portfolio to, reduce the volatility within the captive by adding premium volume, and they're looking to participate more in the risk, right? So if you have a group who is comfortable taking risk and wants to pay less in fixed premium to a stop loss carrier and kind of self-fund more of that risk internally, that can be a good solution for a larger employer. But it's also dependent upon what their experience has been. I kind of take issue with some out in the market who will pitch single parent captives as the best thing since sliced bread. And like it's a one size fits all. Like this is where everybody should be moving to. I think that's naive.
You don't agree with that?
I don't agree with it at all. I think that there needs to be, an analysis. There needs to be a study that's done that takes a look at the history that group has had, what kind of profitability they've had from a stop loss perspective. Because if you have a group who is running consistently poor, right, and has been actually having more stop loss reimbursements than they've been paying in premium, the single parent captive isn't a fix for that, right? I think
That's
people
right.
sometimes feel like the captive is the fix. It's just an alternative funding solution that allows you to participate in the risk. So if the risk is good, then you're able to keep more of that money in-house and not pay it out in stop-loss premium. But the flip side is also true, right? If you're not running well, this isn't going to all of a sudden turn your experience more favorable, and then you're bearing more of that negative risk. So I think there really needs to be, on a case-by-case basis, a true feasibility study that's done to figure out, is this a good fit? Sometimes that's larger than just a stop-loss conversation, right? So if it's an existing captive and there's other lines of coverage there, maybe there's some other reasons why putting stop loss in the captive makes sense, even if it ends up being, a break even versus a, huge savings that the analysis shows. But I just don't think it's a one size fits all. I think it's definitely something that comes up quite frequently and we look at it, but I think the answer's got to be dependent upon what the actual data shows.
Sure. Laurie, are you guys seeing small group captives in the work that you're doing?
We are. We're seeing interest there. MMA actually offers 2 in-house captives so that that's available to clients. We've seen some clients take external captive scenarios and go that route. But I do think, the captive scenario is great when they're getting refunds and operating positively. But I agree with Andrew in that, if the claims experience does turn, then it can sometimes feel a little bit different to that particular captive. I think the terms that are sold along with that, are they able to offer no new lasers? Do they have comprehensive coverage? Those types of things do definitely come into play so that the client isn't left in the lurch because they had poor experience.
Carol, how about you? Do you see captives in your space? And even if you're utilizing a small group captive or a single parent captive, a lot of times those entities still need reinsurance as well.
Yeah, we work very closely with our Marsh colleagues on single parent captives, not only looking at the structures, but analyzing the experience, the information, and, placing the ultimate reinsurance strategy, for that particular situation. As Andrew mentioned, looking at the analytics and seeing what the right fit is. It's not a one size fits all. They really are, very different. and unique, and making sure that we're finding the proper reinsurance structure on top of the captive, primarily for single parent captives, is
Sure.
where we're playing in that space.
Great. Well, I want to get you guys out of here with one last question, and I appreciate you guys joining for this conversation. As you think about employers, Laurie and Andrew, and then as you think about the reinsurers, or really the health plans and the stop loss carriers that you're providing reinsurance to, Carol, what's one piece of advice that you give your client as we go into the 2026 renewals? Andrew, why don't we start with you?
Yeah, I would just say just making sure that you have a level of oversight into your high-cost claims activity. I think we have, across the board, we've talked about the increase in frequency and severity of high-cost claimants. So having strong stop-loss contracts, carrier partners, that's hugely important. But I think more and more our clients are looking to us to not only place their stop-loss coverage, but help with their high-cost claims activity. So just having some line of sight into those claims on a regular basis, and finding ways to either improve the experience for high-cost claimants or try and prevent high-cost claimants from happening. That level of oversight is key, and I think employers are really honing in on that. So finding someone who's going to do that on a regular basis consistently is, I think, hugely important.
Yeah, and I would just add, I agree with Andrew, and I would say, to our peers who are in the field offices, that getting good data is going to help to try to allay concerns. An underwriter that's left to their imagination is probably not a good thing. And so...
Not in today's time.
No. It usually leans to the negative. So you want to be able to provide that data and put their mind at ease so that they're comfortable with their decisions, and, you walk into a contract that is solid and you don't have to worry about on a go-forward basis.
And looking at the insurance carrier perspective, it's understanding their portfolio, understanding their book of business. We talked at the beginning about carriers being in different phases of the market. Some are challenged for profitability. Some have already taken some corrective action. So it's really helping our clients understand kind of where they are in that phase, and placing the reinsurance, based on those goals and objectives.
Awesome. Well, this has been a great conversation. I want to thank Laurie and Andrew and Carol for joining me. We'll see you next time on Firm and Final. Thank you.